Okay, tonight I will be talking about Trump's policy and tariff, the AI sector, US market outlook, and lastly, I will share an example of an aggressive portfolio at the end of the webinar itself. Okay, first thing first, let's spend some time on Trump's policy. Okay, the most important thing you need to know is that Trump's policies are pro-growth and pro-business, which should be constructive for the US equity market in 2025. For example, he has said that he wants to extend the 2017 personal tax cuts and lower down the corporate tax rate. The question here is, how likely is Congress to approve Trump's tax cut plan? The answer is quite likely because Republicans have a majority in the House and Senate itself. Trump also pledges to lower the corporate tax rate from 21% to 15% for corporations that manufacture products in the US. The purpose is to bring manufacturing back to the US, meaning more Americans will have jobs, which will ultimately boost the labor market. In addition, Trump also wants to impose a 60% tariff on goods from China and a blanket tariff of 20% on goods from everywhere else. Okay, Trump also wants to crack down on illegal immigration. So the popular view here is that a crackdown on illegal immigration and tariff plans itself will cause inflation. Yes, I agree that tariff will cause inflation depending on how much is imposed. Crackdown on illegal immigration will also lead to higher prices because of the labor shortage itself. However, what the media outlets do not tell you is that Trump also plans to bring down energy prices. So if oil prices come down, perhaps inflation will not be that serious. Besides, as a result of illegal immigration's crackdown and bringing the manufacturing back to the US, more US citizens will be employed and they should be seeing a pay rise, wage growth itself. So if wages in the US are rising faster than inflation, US workers will have more purchasing power. Therefore, inflation is not that scary because the goods are affordable because of the increasing purchasing power itself. So I'm not that worried about inflation. Next, Trump also wants to have a say in the FOMC rate decision made by the Federal Reserve itself, because Trump has promised lower interest rates despite the inflation risk. Okay, in 2017 and 2018, Trump tried to remove Jerome Powell as chair of the Federal Reserve. Recently, Jerome Powell said in the September FOMC meeting that he would not resign if Trump asked him to. Personally, I believe that Jerome Powell will most likely maintain the Federal Reserve's independence, even if he is once again being threatened by Trump itself. Because seldom does a Federal Reserve chair serve more than 2 terms or 8 years. I think Powell may not be optimistic about being re-elected as Federal Reserve chair when his term expires in May 2026. So he will not be swayed by anyone in terms of the FOMC rate decisions. And given the US economy strength and reflationary risk under the Trump administration, I believe Powell will likely cut rates cautiously and slowly in 2025 and 2026. However, I still do not think that he would raise interest rate, especially given the weakening labor market. Overall, I believe that Jerome Powell is dovish. Okay, one of the commonly asked questions is, which sector will benefit under Trump 2.0? A lot of analysts say it is financial sector, and I agree. Okay, so some of the investment thesis for the financial sector include firstly, financial deregulations. The story here is that regulators are expected to ease capital rules, allowing banks to have fewer constraints and use more cash for lending or share buyback, and this would likely lead to more mergers and acquisitions, as well as less antitrust enforcement. Secondly, a stronger economy will benefit cyclical sectors like banks. Personally, I'm not that familiar with US banks, but I reckon one of the better ways to gain exposure is through the bank ETFs like the XLF ETF. Additionally, I like Visa, MasterCard, or Berkshire Hathaway. Okay, the energy sector will also um, benefit under Trump. Trump previously vowed to cut the US energy costs by 50% within the next 1 year. This is why a few days ago, Trump also called for a deal to end the Ukraine war because he wants to bring down the energy prices. Trump wants to quickly expand oil and gas drilling. However, I am unsure about the energy sector. I believe that even though oil and gas companies will increase production under Trump, energy prices will also be lower. This is because Trump wants to reduce energy prices to fight inflation. So ultimately, I don't reckon that oil and gas companies will benefit much. It's like oil and gas companies can increase production volume, but will be selling at a lower price. Therefore, I'm neutral on the energy sector. Okay, next, automobile industry. Trump is not a big fan of EV, electric vehicles. This is why he wants to remove the 7,500 consumer tax credit for EV purchases. Ideally, traditional automaker like Ford and GM should benefit from this, but I just don't like them. I don't like the traditional car makers. The ICE industry has not been performing well for the past few years. I believe that Trump's policies may help traditional car makers survive longer, but I'm still cautious about their long-term outlook itself. I believe that if Trump really revokes the 7,500 tax credit for EVs, it could potentially benefit Tesla. Tesla might need to cut the car prices, which would ultimately reduce the profit margins. But other EV makers will incur more losses if they were to cut the prices itself. So this should give Tesla a competitive edge. Additionally, Trump may also increase tariffs on EV from China, which could benefit US-based EV maker. Okay, and there are some hurdles for Tesla robotaxi business. At this moment, NHTSA will only allow every EV maker to deploy 2,500 robotaxi per year. But Tesla wants more than 2,500, obviously. Some states still require steering wheel and pedals, and Tesla also needs the state approval to run the robotaxi business itself. However, Elon Musk has been pushing for federal approval, and Trump is expected to help Tesla with the robotaxi rules. This is why Tesla stock price has increased by about 80 something percent since Trump won the elections. To me, I only like Tesla in the automobile industry. Okay, the sector I like the most is technology. Basically, if the US wants to win the tech war, the technology war, it needs to make the technology companies stronger. So some of the investment theses include, firstly, AI deregulations. The Trump administration is committed to strengthening US leadership in AI. Trump has previously promised to roll back Biden's executive order on AI. Secondly, the FTC chair, Lina Khan, is widely expected to be removed by Trump in January. The FTC is basically the agency responsible for enforcing antitrust law in the US. And over the past few years, the FTC has targeted big tech companies by blocking the merger and acquisitions and suing them for monopolistic practices. So it's widely expected that the big tech companies like the Mag 7 will benefit from Lina Khan resignation itself. Okay, thirdly, Trump is expected to be business friendly. Trump is likely to encourage more M&A and an overall reduction in the technology industry regulations. Some analysts also speculate that big tech companies are asking for Trump's help to pressure the EU and UK to stop imposing lawsuits against them for monopoly. So all in all, in order to preserve the US position as the global technological leader, the tech industry, especially the AI sector, should be a key focus for Trump support. Okay, here I want to show you the sector performance. This column represents the 2024 year-to-date return, and the rest are the monthly return. Okay, I want you to focus on December month-to-date return and November. A couple of takes away here. Firstly, technology-related sectors like communications, technology, consumer discretionary remain some of the top performing sectors this year. Especially in December, when other sectors are not doing so well. These three sectors itself are providing better performance relative to the rest. This is why I like technology sectors, because with or without Trump's policies, AI itself is an organic growth trend. So this sector should continue to do well simply because of the AI boom. Okay, secondly, sectors poised to benefit from Trump 2.0, namely the industrial industry, financial and energy industry itself, begin to experience some correction, some sell down in December. For example, financial industry went up 10% in November, but dropped by 7% in December itself. Energy went up 7.7% in November, but dropped 11% in December. So these sectors may have overpriced Trump optimism. So investors are shifting their focus back to long-term secular trends like AI, AI sectors itself. So in short, I like technology sectors rather than other Trump benefiting sectors, because Trump may under-deliver on his promises, but the AI trend should continue regardless. Okay, let's talk about tariff. Okay, about 1 month ago, Trump said he wanted to impose 25% tariff on Canada and Mexico and an additional 10% tariff on China. Basically, if the US imposes tariff on any country, that country will still want to export to the US because it is difficult to find a replacement with the size and appetite of the US. So the common way is to, the common way to make your goods still look affordable to US companies is through currency depreciation. For example, in 2018, 2019, the renminbi depreciated as much as 13% when the US imposed a 25% tariff on Chinese goods. So Trump tariffs are a negotiating tactic to reach a deal. For instance, Trump wants Mexico to stop the illegal immigration, or he may want China to buy more US soybean. If a country does not want to sell to the US because of tariff, the country may consider dumping. Dumping is basically selling goods at below market prices to other countries in order to capture market share. However, this may also prompt other countries to impose higher tariff as well, because dumping would hurt the local businesses. To avoid the tariff, some companies may consider moving their factories overseas. For example, some companies could relocate to ASEAN countries. However, this strategy may not be effective because, firstly, reshoring factories takes time. Secondly, the US plans to increase taxes on countries that act as intermediaries in re-exporting goods to the US. Thirdly, reshoring will hurt the labor market in the country facing the tariff. To me, the best way for a country to defend itself from the US tariff is through currency depreciation, or by reaching a deal with the US as soon as possible. But if you ask me about the tariffs impact on the US, I would say that it poses an inflation risk. However, Trump is also trying to deregulate the energy sector to bring down the inflation and increase Americans' purchasing power to afford the inflated products. So it's just too early to tell how bad inflation will be next year. In any case, when Trump imposed tariffs on China in 2018, when you look at US CPI year on year, I don't reckon I saw a spike in inflation. Inflation shot up in 2021 and 2022 due to supply chain bottlenecks caused by COVID-19. So if we take a lesson from the 2018 tariff itself, maybe we won't see the inflation spiral out of control. Okay, I reckon the US will try to impose tariffs on countries that have the largest trade deficit with the US, and on countries that have the highest increase in their trade deficit with the US in 2023 compared to 2018. So these are some of the countries that may be at risk of higher tariffs, but maybe not Singapore. But it's not all gloom and doom. Companies can request tariff exemption. So while tariff may sound serious on paper, ultimately, if most companies are exempted from tariff, then you should not be worried about the inflation risk. Okay, let me drink some water first. Okay, next, I want to talk about AI. Okay, I have shared a lot about the AI trends in the past. Just bear in mind that the AI total addressable market is huge. The valuation for a lot of AI stocks is expensive, but still not as crazily expensive as during the dot-com bubble. For example, the PE ratio for Nasdaq 100 is now trading at 35.6 times. And if you were to look at the peak of the dot-com bubble PE ratio, it was trading at 175 times. Okay, 1995 marked the start of the internet monetization. It also kick-started the dot-com bubble. The entire dot-com bubble lasted for 5 years, from 1995 to year 2000. At its peak, the S&P 500 returned 265%. If the AI boom is just a bubble, similar to the dot-com bubble, maybe it can continue for another 5 years, starting in 2024. And so far, S&P 500 has only gone up by 24%. Okay, Nasdaq 100 returned more than 1,000% during the dot-com bubble. Nasdaq 100 only returned 27% so far this year. Okay, this is the AI value chain. I have talked about them before. Okay, recently Broadcom went up by 20-something%, about 24%. But Nvidia, on the other hand, went down by 6%. I reckon the reason is that some investors are selling off their Nvidia holdings and investing in Broadcom. Investor likely believe that ASICs, Broadcom's custom AI chips, can replace Nvidia's GPUs. I reckon they are wrong. Custom AI chips can complement Nvidia's GPUs, but they cannot replace them. For example, have you ever wondered why Amazon's custom AI chips, Trainium, are sold at a 40% discount compared to Nvidia's GPU? Why? Why didn't Amazon sell them at a higher price, but at a 40% discount? It is because Nvidia's GPUs are still the best AI chips for AI training. So most companies prefer Nvidia's AI chips for training because if they don't use Nvidia AI chips, they risk falling behind in AI performance. Besides, the AI training market has a larger total addressable market compared to the inferencing market itself. To me, most custom AI chips work best for inferencing, but not AI training. Custom AI chips are typically optimized for specific tasks within the AI process. AI training itself, which require higher computational power, still needs general purpose GPUs by NVIDIA's. So all in all, I am constructive about the AI training and inferencing market. If you want to find those AI inferencing market beneficiaries, they include Broadcom, Marvell, ARM, Microsoft, Alphabet, Amazon, and TSMC. Okay, this is the AI S-curve in 4 phases. So phase 1, infrastructure. Phase 2, edge AI, which include AI smartphone and AI PC. Phase 3, AI agents like Copilot. Phase 4, physical AI like self-driving cars and AI robots. Okay, so these are the companies that should benefit in phase 1 and phase 2. I will not go through them. You are welcome to take a screenshot if you want. At this moment, market participants seem to be buying all companies across 4 phases itself. Okay, but I reckon you will hear more about AI agent in 2025. I believe AI software companies could probably outperform in 2025. If you are unfamiliar with the names under these 4 phases, just remember that Magnificent 7 stocks should benefit from this AI boom. Okay, so That's all for AI. So let's talk about the US market outlook for 2025. Okay, as you can see, these are some of the 2025 year-end forecasts provided by various research houses for the S&P 500. On average, the year-end target price is 6658, representing a 13% upside compared to yesterday closing price of 5872. The most bullish house is Oppenheimer. They predict a target price of 7,100 for the S&P 500. However, I want you to know that analysts often change their target prices. So I suggest you treat this target price with a grain of salt. Okay. Personally, my base case scenario for the year-end 2025 target price is 6711, representing a 14% upside. In the worst case scenario, I expect the S&P 500 to close at 5,100 in 2025, representing a 13% downside. In my worst case scenario, I expect the PE ratio to compress from the current level of 26 times to 20 times. And earning per share is only growing at 6% year on year. In my best case scenario, I expect S&P 500 to go up by maybe 25% to close the year at 7330. Bear in mind that in my best case scenario, I expect earning per share to grow at 15% year on year. The 15% earning per share growth aligns with the Fed set forecast. I also expect the PE ratio to stay high at 26.6 times. And you can also see that the current PE ratio is already at 26.4 times as well. So I do not expect the PE ratio to compress in my best case scenario. I would say that to sustain the high PE ratio, I think technology sectors, especially the AI-related stocks, need to stay elevated. Okay, here are the half-month returns since 1950. Now we are in the second half of December. The average return is 1.35%. 78% of the time, S&P 500 returned positively in the second half of December. However, in 2024, S&P 500 is down by 3% in the second half of December so far. So maybe S&P 500 can stage a rally later if history repeats itself. I also want you to look at the performance in the first half and second half of January. Generally, 59% of the time, the first half and second half of January generate positive returns. The average return is 0.44% in the first half and 0.61% in the second half of January. So investors could still remain constructive from now until the end of January. But a lot of investors are still quite underinvested because they are afraid of a major sell down, given that S&P 500 has gone up more than 20% for the past 2 years, for 2 consecutive years. In 2023, the S&P 500 returned 27% and 2024 may return 25%. So investors reckon that there might be a correction in 2025. However, historical data also tells us that when the S&P 500 is up more than 20% for 2 consecutive years, 67% of the time, the following year return is positive. The average return for the next year is 8%. Median return is 13%. I also want to draw your attention to 1995. Uh, Again, 1995 marked the start of the dot-com bubble, which lasted until year 2000. During that period, the S&P 500 experienced 5 consecutive years of more than 20% return. 1995, 38%, 1996, 22%, 1997, 33%, 1998, 29%, 1999, 21%. I am not saying that S&P 500 will provide more than 20% yearly returns for the next 3 years. What I'm trying to say is that if this is an AI bubble, the upside could be more than anyone expects. Okay, 2025 will be the first year of Trump's presidency. Generally, the S&P 500 provides an average return of 10% in the first year of presidential terms since 1960. So it's probably a good idea to stay optimistic for 2025. The next question you should ask is, which months should you stay alert? Should you stay cautious? Okay, the S&P 500 may experience some sell-offs during 2 periods. First, from mid-February to end March. Second, from early August to end September. And I think that a sell-off starting in mid-February is likely, since Trump's inauguration is on January 20th. He may under-deliver on his promises. As a result, the market may see some corrections beginning in February. If we look at the S&P 500 returns in the first year of US presidential terms since 1950, the average return is negative 1.55% in February, negative 1.38% in August, and negative 0.28% in September. So just be cautious during these months. However, seasonality is just seasonality. Sometimes it works, sometimes it doesn't. For example, here is the average S&P 500 performance in election years. I have shown this many times in my webinar this year, and I told many customers, many investors that they might see some corrections from February to March and from September to October this year. But what really happened in 2024 is that there was no correction in February and March. The S&P 500 only encountered a sell-off in April. And there was no sell-off in September and October this year as well. The major sell-off this year happened in July. So the moral of the story here is that seasonality can offer guidance for investors, for investing, but it should not stop you from investing if seasonality does not play out as expected. Okay, let me quickly talk about technical analysis. Let's take a look at the S&P 500. Here are the Fibonacci conference zone for the S&P 500. To me, the major resistance is 6850. TA tells me that 2025 target price is 6850 based on technical analysis. If you are waiting for some support levels to accumulate, 5,900 or 5,500 may be some good support levels. Yesterday, the index closed at 5872. To me, the S&P 500 must hold above 5,900 to resume the bullish trend itself. Okay, let me go through the downside and upside catalyst for the US equity market. Okay, what could potentially upset investor in 2025? Firstly, even though I'm not overly concerned about tariffs, they may be more damaging than I initially thought. Secondly, investors are worried about a second wave of inflation due to Trump's expansionary plan, crackdown on illegal immigrations and tariffs. So the blue line here that you can see here represent the CPI year-on-year growth at the moment. It does not seem like it's shooting up yet. And you know what? I don't reckon you should be worried about a second wave of inflation right now. Just don't worry about something that may or may not happen. Yesterday, the Federal Reserve cut rates by another 25 basis point. The 25 basis point cuts was widely expected. However, the Federal Reserve is also expecting smaller rate cuts in 2025. This caused the Nasdaq 100 to drop more than 3% yesterday. Okay, previously in September, FOMC meeting, market participants were expecting 5 rate cuts in 2025. 2 days ago, they were expecting 2 rate cuts in 2025. And now everyone is expecting just 1 rate cut in 2025, which supposed to happen in June 2025. And that's all. I reckon 1 rate cut for the entire year of 2025 is too pessimistic because, as Jerome Powell said, the labor market is cooling. To me, it is high inflation versus a weakening labor market. I think that the Federal Reserve is likely to cut more rates to support the labor market because a cooling labor market is a bigger threat to long-term economic stability than inflation itself. As long as the Federal Reserve is not hiking the interest rate, I will stay constructive on the US equity market. Positive thinking. If the Federal Reserve is slowing down the rate cut cycle, the bull run may last longer. Smaller rate cuts and a longer rate cut cycle suggest that the US economy is strong enough to handle higher interest rates, which can help sustain the bull run for a longer period without triggering inflation or economic overheating. Okay, some other reasons that could cause a sell-off include the equity risk premium is negative, lack of market breadth, expensive valuations. Additionally, companies have spent a lot of capex on AI, which may compress the profit margins. Lastly, the earnings growth may disappoint due to high base effect. Basically, if year-on-year growth, the year-on-year earnings growth were 100% in 2023 and 100% in 2024, they may not be able to grow another 100% next year in 2025. Investors should perhaps only expect smaller year-on-year growth in earnings next year. Okay, now let's talk about the upside catalyst in 2025. Firstly, there could be a no landing scenario where there is resilient economic growth, but inflation is close to the Federal Reserve target. Secondly, AI is still driving the stock market. Thirdly, multiple expansion. The PE ratio for the S&P 500 is now 27 times. It may continue to expand to 30 times or even higher given the AI optimism. Fourthly, investors are underinvested. Basically, I look at 2 metrics to check if investors are still underinvested. Firstly, money on the sideline. There is still 6.7 trillion cash sitting on the sideline in the money market funds. This is about 41% higher than the COVID high itself. Secondly, FINRA margin debt. FINRA margin debt is the amount of money investors borrow from margin account, and the amount is currently $815 billion, about 13% lower than its all-time high here. Okay, so this indicates that investor may not have borrowed enough yet. Okay, next, multiple expansion. The earnings outlook for 2025 is not bad. It could help sustain the PE ratio or even push it higher. Lastly, Trump is good for stock market. During Trump 1.0, the S&P 500 went up by 84% despite COVID-19 and the trade war. So all in all, I am bullish on US equity market in 2025. Okay, we are here. We have come to the final few slides. I want to quickly recap the aggressive portfolio I constructed at the beginning of the year and show you a brand new 2025 portfolio. Okay, firstly, this is the aggressive portfolio I have shown you many times since the beginning of the year. When I first constructed it, I told myself that I would not rebalance for the entire 2024, and I have kept that promise. So I basically did nothing for the entire year. Some stocks like Pinduoduo and AMD have provided negative returns, but that's okay because I have let the winners run for the entire year. Some of the investment darling here include Nvidia, which went up by 160%, and Tesla, which went up by 77%. All in all, the year-to-date return as of yesterday is 46%, beating the S&P 500 25% and Nasdaq 100's 27%. So as you can see, for the most part of the year, the aggressive portfolio represented by the white line has been outperforming the S&P 500 and the Nasdaq 100. There is some major sell down in July for this portfolio, but that's okay because in any aggressive portfolio, you should be expecting large drawdown as well as big, large upside as well, bigger upside as well. So one key thing to note is that this portfolio has a 56% weighting in the Magnificent Seven stocks itself, but most of the Magnificent Seven stocks were underperforming the S&P 500 in August, September, and October. They only start to pick up in November and December. So I guess the lesson here is that sometimes you just need to stick to what you think will work rather than going in and out so frequently. In 2025, I have decided to change some of the holdings here. So basically, I will remove Block, Pinduoduo, AMD, as well as the small cap ETF, IWM here, represented, IWM, because I have started to lose patience with them. Okay, so this is probably the most important slide of this webinar. This is an example of aggressive portfolio I constructed for next year. So basically, this portfolio will only start to track the performance beginning next year. Again, I plan not to do anything. I plan not to rebalance or change anything for the entire year unless something important happens. So some key features of this portfolio are the Magnificent Seven account for 60% of the portfolio weight. If you look closely, Nvidia and Amazon accounts for 13% and 10% of this portfolio, respectively. So I expect that Nvidia and Amazon to be the best performing stocks among the Magnificent Seven next year. Semiconductor stocks account for 33% of this portfolio weight. This include ARM, Broadcom, semiconductor ETF, TSMC, and NVIDIA. AI-related stocks account for 80% of the portfolio weight. So if AI stocks plunge in 2025, the portfolio will perform badly. Lastly, stock with lower correlation to AI only accounts for 20% of the portfolio weight. They include Visa, MasterCard, McDonald's, Eli Lilly, Berkshire Hathaway. And there is only one smaller cap stock, if you consider ARM is small cap stock. So in this portfolio, ARM is the stock with the smallest market cap at 143 billion. So even though this portfolio is heavily tilted towards the AI thematic, most of the AI-related stocks are large cap companies. Here, I also want to show you the yearly return, annualized return, standard deviation, and maximum drawdown. I want you to pay close attention to the standard deviation and the maximum drawdown. Overall, this aggressive portfolio is a high-risk portfolio. Some of the stocks here have a standard deviation and maximum drawdown that are easily double that of the S&P 500. For example, the S&P 500 has a 10-year standard deviation of 18%, while NVIDIA is 48%. The S&P 500 has plunged as much as 34% in the past 10 years, but NVIDIA has dropped as much as 66%. So please do your homework. Please do your research to better understand the company in this portfolio and make sure you understand your own risk profile itself before taking a page from this aggressive portfolio. Okay, that's all for me. Okay, we can now move to the Q&A session. If you have any questions, please type in the Q&A box. Okay, I will leave you with some time to type your questions. Meanwhile, let me open up the app as well. Okay, okay. First question. Is USD still stable currency in the next 10 to 20 years? Okay, I would say that USD will still be one of the best safe haven currency in the world for the long term. But I don't have a forecast here that if it can stay this way for the next 10 to 20 years. But at least for now, I don't think you should be overly concerned about de-dollarization risk. USD is still the dominant payment currency at the moment in terms of global payment processed on SWIFT based on the transaction value itself. USD has an undisputed market share of near to 50%. Renminbi is about 5% and Euro is about 20%. So all in all, USD will still be widely used and the US economy will still be growing strong for the next few years. So I reckon USD will be a stable currency for the short to mid-term. Okay, which is the best sector to invest in 2025? I would say probably technology sector, especially AI sector, could still be one of the best performing sector in 2025. But again, it's a high risk sector as well. Reason and why I like AI, because I believe that AI is a long-term secular growth trend. I believe that a lot of other sectors are quite policy driven. AI is more of organic growth, meaning to say with or without the Trump policy, AI sector, technology sector should continue to do well, regardless. Okay, will interest rate cut continue? Yes, uh, I believe the rate cut will continue. Uh, the FOMC, the Federal Reserve, is predicting two rate cuts in 2024, another two rate cuts in 2026 itself. I would say that maybe they are a bit conservative. And I also believe that Federal Reserve are more concerned of the labor market than inflation. And labor market data like non-farm payroll still look quite soft for now. Okay, this is a good question. For AI, should we focus on big companies or small companies or both? Uh, on a safer aspect, I believe that investors should focus on big tech companies like the Magnificent Seven, Broadcom, TSMC, Oracle. If you want to gain exposure to smaller AI stock, I like ARM. Uh, ARM market cap is about 140 something billion. I'm not quite sure if that consider small to you. I believe the main reason you are asking this is because a lot of smaller AI companies has run up quite a lot, like app-loving, SoundHound, and Upstart. But if you have noticed, or at least to me, I feel that most of the smaller cap rise and fall uh, quite quickly. Meaning to say, after these small cap companies run up in prices, the share price do not stay elevated for too long. So I'm quite biased against small cap AI stock. I prefer large cap AI stocks. But if you want some smaller cap AI stock exposure, one of the way is to to control your position sizing itself. Okay, allocations percentage in US versus China versus India. I reckon it largely depends on your risk profile. Personally, uh, I am an aggressive investor, so I don't really like diversifications. I like to add volatility in my portfolio, and I like concentration risk. So probably I would have allocated 100% in US. But having said that, it doesn't mean that I don't think that equity prices for China and India won't go up. For example, I reckon Hang Seng Index may go up to 25,000 provided that it's larger China stimulus. But I would say that investors need to know that you are at the mercy of China's stimulus, the China policy itself. Um, I like India, but I would say that probably one of the best uh, way to gain India exposure is still the India ETF itself, or you want to uh, invest in those US company that has a growing presence in the India market, like Amazon, Google, or Apple. They have a growing presence in India. Okay. Okay, AI, which top 10 AI stocks to explore? Um, I reckon all the Magnificent Seven stocks are AI related. I also like ARM, TSMC, Broadcom, Oracle, maybe AMD. Uh, I am a bit neutral on ASML at the moment, but I would probably look at the next one or two earnings uh, before become constructive on uh, ASML again. Okay, will there be a recession in 2025? Um, I don't recall any analyst talking about recession in 2025 in the past 1 or 2 months. I think most of them are seeing a soft landing scenario at worst, but not recession. I think that the correct way to look at this is that there is always recession risk. There is always a recession down the road. It's just a matter that whether you will think that this company are still worth investing and can ride through the recession, if there is really a recession happening in 2025. Okay, what will be the impact and future of the Chinese ADR? It's a good question. But I don't think I have a good answer for you. So in 2020, Trump tried to delist the Chinese ADR from the US exchanges if the Chinese companies are not complying with the audit inspection in US. But I don't recall seeing any news about Trump trying to delist Chinese ADR for the past few months. So I am not that worried at the moment. Yeah. Okay, speculative stocks like Tesla with the current high price, what are your takes in terms of stocks and option tradings? Okay, in terms of option tradings, I guess you may choose to sell cover call or buy protected put. Uh, but I also believe that some speculative stocks like Tesla and Palantir can surprise investor more on the upside. So I don't think sell short is a good strategy. My preferred strategy is still that if you like this company, like if you like Tesla, my preferred strategy is to wait and accumulate if there is any dip. But for some speculative small cap stocks, uh, look quite overvalued now. There is not much fundamental story about the small cap stocks. So I would say that try not to be formal and invest in those small cap stocks if you don't really understand them. Okay. Do you think that market is at the peak now, and what do you suggest for defensive strategies? I don't think market is peaking now, but like I mentioned in the earlier slide, there could be a correction in February and another corrections in September, but still, uh, maybe US stock could end up higher at the end of the year. But if you want to adopt a defensive strategy, you can look at short-term duration investment grade bond like uh, AGG ETF, BN should be BND ETF, or money market fund as well. You can also look at some defensive sectors like the consumer staple ETF, healthcare ETF, or you can look at some defensive stocks like McDonald's, Coca-Cola, Pepsi. Uh, if you are scared of a market crash, you and you want to hedge your position, you can look at buying protected put options or those inverse ETF like the inverse S&P 500, inverse QQQ ETF. Okay, since Trump became new president of US and Federal Reserve cut interest rate, uh, rapid rise of AI stock can last for how long? Um, Again, my best case scenario is that AI trend could last for another 4 years if this is an AI bubble. The dot-com bubble previously run from 1995 to 2000. If this is an AI bubble, then I would say that 2024 is just the start of the AI bubble and maybe for another 4 years. Okay, how will Trump policies affect the Singapore market? Okay, first of all, US is having trade surplus with Singapore. So I guess Trump may not impose a tariff on Singapore, but if trade tariff on other countries eventually cause a slowdown in global trade, then Singapore as a global trade hub will be impacted as well. But to what extent, I don't know. Another thing you should know is that Trump policy may cause higher inflation. So we may see higher rates for longer, which will be constructive for banks. And the three banking stocks here account for 51% of the STI weightage. But higher rates will be negative for rate cut beneficiaries like REITs, properties, and those dividend paying stocks itself. China is also Singapore's largest trading partner. So if China economy faces slowdown because of the US tariff, Singapore will suffer as well. So that would be my answer. Okay, should we hold on entering the US now with its high valuation and possibility of correction? Um, Let me drink some water. Okay, US equity market is always expensive in terms of valuations. US is always facing higher likelihood of correction compared to other countries. Personally, I'm super bad at market timing. I can tell you that based on seasonality, US stocks may have a correction in February and March, but the correction may come or may not come. I don't think investors should be 100% staying on the sideline at the moment. They should not be holding 100% cash on the sideline. I reckon they should be at least 70% invested in the market now. Okay, what would be the greatest risk to the US market in 2025? Good question. To me, it is policy mistake by Federal Reserve. For example, if Federal Reserve decides to hike the interest rate and cause the labor market to weaken some more, you may be seeing a recession scenario. Okay, I think I have answer. Okay, there are still a lot of questions coming in. Okay, maybe I just take one or two questions and then I will just call it an end. Okay, let me answer this question from Edison. Any reason why AMD is not in your 2025 portfolio? Because I think that in 2024, a lot of investors maybe have decided that NVIDIA will be the sole winner in the GPU market. This is why they kind of like not pushing the AMD share price higher in 2024. itself. If you were to look at the share price performance of AMD in 2023 and 2024 versus the share price performance of NVIDIA in 2024 and 2023, you would notice that NVIDIA is the winner. NVIDIA is still capturing the 90% AI GPU market share. AMD is probably less than 8% itself. So I would say that if you really need to choose one, maybe NVIDIA would be the better choice. AMD will always be the laggard. Whenever NVIDIA share price rose too much, AMD will play some catch up because people will look at AMD and say that, okay, AMD is quite cheap in terms of valuations, so they want to invest in AMD. But I would say that in the AI GPU space, I think that market has decided that NVIDIA is the winner. It's similar when you look at the foundry business. When investors are considering Intel, Samsung, and TSMC, they have decided that TSMC is the winner. Mm. Okay, let me quickly answer these questions. What is your take on Intel? I don't like Intel. I think they will be struggling to find a good CEO. And I will also say that the foundry business is loss-making. The profit margin is just negative. So basically, if they want to sell it to someone, that company will really need to take a bet on the foundry business because it's loss-making. So I would say that I don't see an out for Intel at the moment. Okay, last questions. What about the quantum computing shares? Okay, quantum computing, I don't see quantum computing I don't think that company can monetize quantum computing soon. It is maybe they can monetize the quantum computing in the next 2 to 3 years time. And Google is definitely on the lead at the moment. The next player is probably Microsoft, which we really do not know itself. But I understand why you want to know about them because a lot of the quantum computing stocks have gone up a lot in prices itself. But my personal investment thesis is that probably don't invest in something that you don't really understand. Yeah, so I would say that I don't really know much about them right now, and I believe that they will take some time for them to monetize. So even if you do not go in year one, but if quantum computing is a long-term circular trend, you go in year 2 or even year 3, there is still much growth left in the quantum computing space itself. So sometimes you just need to miss the year 1 and maybe going in year 2 or year 3 when you finally understand more about them itself. Okay, I hope I answered your questions. Okay, so thank you everyone. Thank you for joining me. I wish to have another one, a physical one, a seminar in January. And after the Trump inauguration day, I plan to organize a webinar in mid-February itself. So I hope to see you again. Thank you. Happy trading. Merry Christmas. Happy New Year. See you soon. Okay, bye.